Good afternoon, everyone. Welcome to the ESS BizTools and our affiliates COVID-19 Survival Panel session number 13. Today, I have two guest presenters with me, Amanda Gascoigne. How are you, Amanda?
Great, thanks, Peter. How are you today?
Good, thanks. And Matt Vitale from Virtual. How are you, Matt?
Great, thanks, Peter. Thanks for having me along.
Thank you very much and welcome. So let's just, and welcome also to any people from Facebook who are watching this webinar as a live presentation. Welcome, and I hope you enjoy today's presentation. Amanda's from Amanda Gascoigne Consulting at Port Stephens, New South Wales in the Hunter Valley. And Matt Vitale is a Joint Managing Director of Virtual, one of the crowdsourced funding intermediaries. And Virtual are based in Melbourne. So welcome to both of you.
Thanks, Peter.
I'm Peter Towers, the Managing Director of ESS BizTools. If you have any questions and you're watching this as a live webinar, can you please just go to chat and type in your question? Or if you're watching on the feed to Facebook, you won't be able to do that. So can you send us an email, please, peter@essbiztools.com.au. And obviously, if you're watching this later on at some hour that suits you over the weekend or next week, please just send us an email and I will pass on your question to Amanda or Matt to get back to you. And we will place the question and the answer on the ESS BizTools website in the material on COVID-19. A call to our viewers in Melbourne also and Victoria generally. We are very much sympathetic to the situation you've got down there. Stay safe and hopefully everything will get sorted out over the next few weeks. But it's a real problem for you. And I shudder to think what it's doing to your accountancy businesses and to your clients' businesses. But good luck. Starting the new year with success mindset and some practice management tips to help you achieve this. This is the comment that Amanda's going to give to you today. So I'm now switching over to Amanda. Welcome, Amanda.
Thank you. And I'm going to share my screen and play from the current slide. So you can see all that, everyone?
Yes, thanks. Yep, and you're on the screen there now. Thank you.
Excellent, excellent. Well, yes, thanks, Peter, and thanks for having me on again today. Today, I want to talk about starting the new financial year with a success mindset. And it's something that I've been speaking to in my group called The Balanced Firm on Facebook, and also with my coaching clients and a lot of other accounting practices all over Australia. But I wanted to differentiate initially between a survival mindset and a success mindset. And I think, you know, obviously in COVID, we're in survival mode, many of us, but it's not just during COVID. This is something that I've been seeing for a number of years now, that accounting practice owners are in survival mindset all the time. So pretty much they're finishing one financial year, you know, down to the wire, getting that last tax return lodged and things like that, and straight back into a new financial year. So it's like they are on that hamster wheel and they're just basically going from one deadline to another, one lodgement program to another, one crisis to another. And it's not giving them any time to actually sit and really think about what they want from their practice. And as a result, it's the same results year on year. And in fact, what I'm seeing is that practice owners are working harder and harder and actually getting remunerated less and less year on year, as opposed to those practice owners with a success mindset that are actually making the time to step back from their practices. I mean, everyone's got the same amount of time in their days, but sometimes it's a matter of actually having that mindset to say, I just don't want to keep doing what I've been doing. So it's stepping back and really strategizing as to how they actually want their year to progress. So instead of being sort of task oriented, they're actually more project and more thinking bigger picture of how they want their practice to look. They're actually doing their workflow scheduling, they are setting their goals, they're reviewing their numbers and their KPIs and what's happening in the industry. And that's what I'm going to talk to you a little bit about today, how you can actually do some of these things that my clients are actually doing right now, and the things that I did in my practice over those 18 years to really help me get the success and actually be remunerated for the work that I was doing. So to actually kick this off, I want you to be thinking about what success means to you. And perhaps over the weekend, you can grab a piece of paper, a cup of coffee, maybe a wine, a beer, and think about what success means to you, because this is something that's really personal. And this is one of the things that I really like to get into with clients, working out what that means to them, because once you know what your drivers are, you can help engineer everything else around that. So does that mean, is it money that is the thing that means success to you? Is it status? Is it having the freedom and flexibility and the choices, which many of us aspire to? Having that lifestyle and having it now, not just in retirement, and just being happy and content. So what does it mean for you, success? And then what's it going to look like when you know that you've achieved that, whether that's progressively or, maybe that's in the next month or the next 12 months. What does it look like for you, and how are you going to know that it's happened? So are you living in the house of your dreams? Are you driving a fancy car, if that's what success means to you? I love a car, but I also make sure that it's under the depreciation car limit. Is it something about paying your bills on time and paying them with ease? Maybe it's a nest egg. Holidaying, of course, we can't holiday exactly where we want these days, but we know when we want. Is it working less than the 40 hours a week? I spoke to someone just yesterday, and they are working over 60 hours a week, and they said they just cannot keep doing this. Obviously we can do it around deadline times, and we can really pull out stumps and tell our families that, we're not going to be as present during those times, perhaps, if that's how you've got to do it, but we don't want that to be our norm. Well, many of us don't. Is it the ability to have regular days off? And, coming back to these other intrinsic things that I think that, especially during COVID, I think we've really thought about what we really want from our life, and we've really gained a lot more perspective. But at the end of the day, I think more and more people want to be happy, they want to be healthy, they want some time for themselves, and they want to actually reduce those stress levels. So, what does that mean to you? I'd love you to write that down on the weekend and perhaps share it with someone for some added accountability. But what we're going to do over the next 10 minutes or so is I'm going to show you the way that I do this with my clients. And it's basically about reverse engineering your 2020-2021 success formula for your practice. And as number crunchers, we know this is the stuff that I'm going to share with you is nothing new, but because we are on that hamster wheel so often, it's something that we perhaps do with our clients, but we don't actually sit down and do for ourselves. So I'm going to show you what I did in my practice and what I now do with my clients. So first of all, work out what money you really want. What is your desired salary? And I shared this a few weeks ago, Peter, when I did one of the other webinars for you, but I shared some of the five different salaries based on a couple of different salary reports. And it's really interesting to, again, take stock to see what other people are actually earning. So there I've got the Australian Bureau of Statistics, their average weekly earnings, and that's of all occupations. So that's the whole average of Australia. And that's $86,000, $268 per annum. Then we go to the more specific accounting studies and salary reports. We've got the good, bad and the ugly from my lovely friends at Business Fitness. They work all their numbers on a $200,000 per annum salary for partners. We've got pay scale of nearly 150. Chartered accountants, who I'm a fellow of chartered accountants, their average New South Wales regional salary is just over 160,000, and we've got Hayes of 125. So that's just to give you a little bit of an insight as to what actually the average for our industry is, and obviously just a standard wage. I'd also like you to compare that with what you were earning before you started out in practice. And also, what do you think is really fair for the hours that you're working? So what is desired salary? Number one in the equation. Secondly is, what are your practice costs? So that's, go back and have a look at what your practice costs were in the last financial year, and maybe do some tweaking, because a lot of things, may change, or certainly with COVID, you may have got some new technology. You may have actually upped some cybersecurity and got some cybersecurity insurance or some other technology in that space. So do your budget as far as for this new financial year with, the right mix of resources, the right technology, the right resource, the support that you might need. Do you need some help with, say, coaching, mentoring, more staff, some other ad hoc support that you might need? And, don't scrimp on things that are an investment. And they're the things like the software, because software and things like that are stuff that's going to save us a lot of time. It's going to be things that can really quicken up and make us more efficient and more profitable in our practices. And one of the things that I also do is actually get my clients to run 2 sets of numbers on here. So we have a bit of a range. So what we think, the minimum, and then what are our nice to have if there was some things that we would really like to be implementing. So it's like, when I get to this income level, or when I make more money, I'm going to have this. I'd like you to actually put that in this formula that you're going to be doing, hopefully over the weekend, and have that in there so you can see those 2 ranges. And then thirdly, do you want a buffer? And I do suggest a buffer. It could be a small buffer, it could be a larger buffer. But that buffer on top of that is, to get a return on investment, because many practice owners have actually purchased fees. So they want a return on that money that they've invested. To have a premium on your wage. So you might be getting the same income that you earned somewhere else before you started your practice. You might be getting less. Or you might be getting more, but is there also a premium for the risk that you're taking, and maybe some of the other things that you're taking on that you really want to be rewarded for? Maybe just some cream on top for those extra hours, or just for backing yourself. And then it's maybe having a buffer. Like I said, it might be not that this 12 months, it might be further on, but like to support some growth, or if you want to scale up in the future or want to get more help. So what does that buffer look like? And then together with the desired salary, your practice costs and that buffer is going to give you your 2021 required fees. And, it is a very simple formula, but when I actually talk about this in my group and talk about it with my clients, it's something that we don't tend to do for ourselves, because we sort of know that we've got plenty of clients. We know that we've got that tax lodgement program to basically guide us through the year, but we're not actually looking further afield than that. So this is actually like reverse engineering, and it works really, really well. So once you've worked out those fees, so it might be just based on the budget that you think it's going to be, the initial one, or it might be that nice to have, then we need to have a look to see, is that doable? So how does that compare with your 2020 financial year? When I run these figures for some people, there actually is quite an imbalance, that the fees actually are not balancing out. And that's what's also causing stress. So they just feel like they're on that hamster cycle, and they just do not know how to get off. The work that you'll do in this is actually going to help you get off that, because it's going to help you make more informed decisions. So as far as, is it doable, looking at your capacity, so the hours you want to work, and then drilling down to the available hours in that after you've taken out annual leave, sick leave, public holidays, CPE, you'd lose a whole week just of CPD. And then obviously looking at your productivity. So if you are a solo practitioner, there's a lot of admin stuff that you need to do. And then looking at that productivity. If you have staff, repeat that same process with your staff to come up with a minimum capacity of fees. And why I say minimum is because these days so many more practice owners are not doing the do and charge, or just hourly rate and charge out rate. They're actually looking at sort of setting fixed fees for certain things. So a standard fee for a tax return, a standard fee for a set of financial statements. So that actually usually will give you a better than a normal hours to do multiplied by a charge out rate. So that's why I say this is going to give you your minimum fee capacity. And then we're going to look at working at, is there a shortfall? That's where, that gives you the ability to then dive deeper and having a look to see where you need to be tweaking. So if those numbers don't add up, it might very well be that your charge out rate is not right. So you need to go back through and look at your charge out rate, because even though you might be doing your fixed fees, that is still loosely based on knowing how many hours roughly that's going to take for that job, plus other things through the year, multiplied by what you think is the charge out rate. And that actually in itself brings a really interesting conversation, because we're so used to looking at charge out rates, comparing them what we actually used to charge years ago, maybe in our own practices, or maybe we work for someone else. But our overheads have actually increased so significantly over the last few years with technology. So if you go and have a look at your overheads that you've just calculated in that formula and go and compare them to a few years before, you'll notice that one of the big things that's probably grown is your technology costs. So the amount of software, that all that subscription-based software that we've got, that is actually a huge amount of overheads for a lot of practitioners, and rightly so. I love it, and I do attest to having that technology, but that needs to be captured somewhere. And if you're not actually reviewing your charge out rate and leaving that on the old fashioned way of maybe calculating it, you're actually selling yourself short. And that's where we see that successful, businesses that feel like they're successful because they're getting more and more clients in the door year on year, they've got more lodgements to do, but yet when they actually go down and have a look at that P&L, they're actually finding they're not making any more money. So that's some of the things of reasoning. It could be if you're using charge out rates, your charge out rate needs to be tweaked. It could be your client base. So having a look to see what is making up your client base. So I get my clients do an analysis to see where everyone's sitting, and what sort of clients are in that 20%, the bottom 20%, and how much they're contributing to your fees. Looking at the client mix and working out whether that's still optimal, and that is the direction that's going to help you achieve that level of success that you want. Fees per client. And I know some of this stuff does take a lot of time, but once you do it once and take the time out, it actually doesn't take that long to do each year subsequently. But what I'm seeing is that there's so much scope creep in particular jobs that clients that you're working on, you've set a fee, and then that client has grown, so too has the work, but you're still charging the same amount. And that's because you're on that hamster wheel that you're doing, just charge what we did last time, not actually realizing that there's actually more in that job. And I've seen that a lot of times with clients, especially when they've actually got staff doing the work. So the staff just keep doing the job, each quarter, say for a BAS, and it's just as charged the same as last time. And then we're looking at those figures, we're realising that that is certainly not a fee that is actually appropriate for the amount of work that's actually being done in that assignment. So it's a matter of actually sitting down and working out what are the fees per client. So with something like that, go in and have a look at particular clients that you might have write-offs if you're actually already analysing that, and having a look to see, has their turnover increased? Has the number of employees they've got increased? And see whether you can see some trends there. And, when you're diving deeper, have a look at more of those industry KPIs and start setting some for yourself. And then once we've strategized, we can now start to strategize with those numbers in mind, and bearing in mind that money may not be your main driver. So financial rewards may not be your main driver. But I think when you've done those exercises, what I find is the light bulb tends to go off for the people that do those exercises. And I've actually had I ran 2 courses that was very much what people were saying, like looking at those numbers and realizing, okay, that's my impetus to start charging more than what I am, because I can see I'm potentially going backwards, but I'm adding so much value to my clients, and, they are my life, and I'm doing so much work. So once you've got those numbers in mind, It'll help you work out what you want to do with workflow, scheduling your clients in. That's how I used to do it, and that actually reduced a lot of stress. What technology that you need to have to help you in the coming year. So I want to see more and more practices not just survive this year and treading water. I want to see them achieve that success level that they actually want. But unless you do these numbers and take the time out to do that, you'll find that is actually, you'll be in survival mode for another 12 months. So there's the success formula. So it's the formula that I spoke about. It's having that success mindset, opening your mind to different things, talking to other practitioners, reading up more of the industry analysis and what's actually happening. And I know Peter, in his newsletter last week, sent the CommBank report, their 2020 financial year report of what's happening in the accounting practice space. So get your hands on some of those things. And those two things together will actually, hopefully, equate to you actually achieving what your definition of success is in the 2021 financial year. And I can help you. There's some grants going around at the moment, and I can help with some small packages just to get you on your way here, taking advantage of, I know in the New South Wales it's just been really released only last week, a $3,000 grant. So things like that, if you need to reach out and get some assistance, I'm available to do that with you. And there's all my contact details to keep in touch, all of the social media channels, my email address, amanda@amandagascoigne.com, and website, and also my private Facebook group called The Balanced Firm that you're very welcome to come and join. And if there's any questions, and that's my presentation, Peter.
Thanks very much, Amanda. In your analysis of firms, people critically considering their mix of clients and saying, well, if we take notice of what's in the CommBank report and try to concentrate more on business advisory services, it might mean that they don't need as many clients because they're going to be doing more work for some of them.
Absolutely. I think there's definitely one of the things that I've sort of, there's another report, The Good, Bad and the Ugly as well, which all these things, if you actually start taking cues from all these different reports, you will actually start realizing that maybe your numbers are a little bit out of sync. So yeah, you're right. The number of clients, I think far too many accounting practices have too many clients because they're good at what they do. So getting clients in is not the problem. It's actually making sure that they're offering the right level of services at the right price to them. And that's where I think everyone's being overstretched. But adding that advisory, and I know a lot of clients say, but they won't want to pay for advisory. We actually see they do. When you actually have the time to sit with your clients and go through some of these, even basic advisory, so a budget, a P&L, having a look at some of their goals, that is basic advisory, which you are all qualified to do and you can do, but it's really the time that you often don't have. And clients will definitely pay for that. And that's what will potentially double or triple their compliance fee. And therefore, then you do need less clients. And also just even what's happening in the individual tax return space and in the coming years. This is actually an opportunity, and COVID, I've said this a number of times, an opportunity to reset if you're using the numbers, other reports, or just, that success, success of what success looks like for you as your opportunity to reset and actually be on a path that's going to be, lead you to actually achieving that success. And there's don't need to apologize because this is your practice and you can do what you need to actually be on that right path for you. But yeah, definitely advisories. There's going to be a lot more. Well, we've been saying that for years and years, but I honestly do. It really is taking us to recalibrate and actually showing our clients what we can do for them. And that is in the SME space as far as accountants and also SME clients. They need this stuff desperately.
Okay, so thanks very much, Amanda. We're going to move on now, but you'll be here if we've got, we want to get questions later on. So I'm just going to take the screen back and It's now my pleasure to introduce Matt Vitale, the co-founder and joint managing director of Birchal. Birchal's a crowdsourced funding intermediary on deal flow, I think probably the most successful in Australia at this stage. So Matt, welcome, and I'm going to let you take over, and you can, oh, I did that the wrong way there. And you can make your presentation. Thank you.
Thanks, Peter. Let me just get this up.
Yes, your screen's up now, mate. Thanks.
Excellent. So look, thanks very much for the time and for the introduction. Birchal is an equity crowdfunding platform. It's a relatively new regime in Australia. We received our financial services license in early 2018. We're among the first 7 platforms to be licensed to host offers. And it's been a period of strong growth, particularly last year, but like many industries, COVID's put, I suppose, a little bit of a halt to the strong growth that we were expecting this year, continued growth of the regime. But it's still been encouraging. We've been able to remain active throughout this COVID period. And I'm going to get to that a little bit later in the presentation. But I'd like to just give a bit of an overview about equity crowdfunding and make some reference to the UK crowdfunding industry, which is the most mature and developed equity crowdfunding industry in the world. And it is important to look at the UK because it can provide us somewhat of an insight into what the future holds for equity crowdfunding here in Australia. But essentially, equity crowdfunding enables small and medium businesses and startups to raise capital online by issuing shares. So this is traditionally a very heavily regulated area, involves tens and hundreds of thousands of dollars of professional service fees, and really something that is only the domain of the public company regime, or was, until now. So it's a very important development, particularly for small and medium business. Access to finance has historically been a really critical issue. For small business owners that don't have property or other security to provide to lenders, the options are fairly thin, and crowdfunding, we feel, has a real impact and strong role to play in improving access to finance for small and medium business. So just talking about some of the challenges that I'm sure, Peter, some of your members will be familiar with, but in terms of raising capital, the challenges for companies and investors just by how time consuming and expensive it can be. It has historically been a largely relationship driven process, and the challenge that we see often for a lot of businesses is who are the investors? How do I access investors and show my opportunity to them? There's limited liquidity. So with private businesses not being traded on an organised market like the ASX, that presents challenges for companies in making the opportunity attractive to potential investors, but also for investors in terms of gauging how long they want to be in for, and I suppose visualising how they can exit the investment when they need to. There's limited available performance data in contrast to ASX, which, with continuous disclosure obligations and regular reporting, and high minimum ticket sizes. This is particularly an issue for investors historically investing in unlisted private businesses, is that given the exemptions that companies usually need to apply, things like the 2012 rule, so no more than 20 retail investors, then for companies to raise a substantial amount of capital means that each single investor in a round needs to typically invest a lot more. So we're talking about tens of thousands of dollars. It's pretty hard to establish a diversified portfolio for many people if the minimum investment in a round is, $10, $15, $20,000. And the investors that have historically been active in this space, angel investors and venture capital investors, they typically favour businesses that have high risk, high return opportunities, basically to sustain their return the fund model that venture capital firms need to work. But this doesn't typically bode well for businesses that are perhaps less risky, but good businesses nonetheless. They find that they're not really the opportunities that these active venture capital investors are looking for. So I referred to the UK market earlier. It's equity crowdfunding is now a very well-established source of funding for seed and early stage businesses. There are two platforms that dominate the market, Crowdcube and Seedrs. I've included some data here from last year, but you can see that 2019, over £430 million was raised in the industry. Pretty much 100% of it was split between Crowdcube and Seedrs, but it is a significant source of capital and a significant industry that I suppose gives us an insight into what we can expect in Australia. Another interesting point to make is that some data from Cambridge University, the Centre for Alternative Finance, they do a survey of crowdfunding platforms in the UK, and they found that there's an increasing rate of institutionalisation among the crowdfunding platforms, and what that means is that more and more angel and VC investors are using equity crowdfunding platforms as a source of deal origination. And anecdotally, what we understand is that angel and VC investors that are out actively looking for opportunities in the market, they spend a lot of time looking, having coffees and meetings with people. But once they started to see deals pop up on crowdfunding platforms, but that perhaps they didn't come across through their own networks, then the realization was that it's perhaps more efficient to just look at the deals that are on the equity crowdfunding platforms. So this is an overview of what's brought us to here, because the UK regime really started around 2011, and it's been a long gestation period to get an equity crowdfunding regime in Australia. September 2013 was when the now defunct Corporations and Markets Advisory Committee released a discussion paper on equity crowdfunding and really considering whether Australia should have an equity crowdfunding regime. And then September 2017 was when the legislation was passed, and January 2018 was when licenses were finally granted. So it was about a 5-year period with lots of government consultation, industry engagement, and a few elections and leadership challenges, if you recall, during that period. So a few things that derailed the process. But delighted that we do actually have a regime now. And I've just kind of sketched out the game changes of the regime. Basically, SMEs can access a retail investor audience now for a fraction of what it would cost historically under a prospectus, which is what a public company needs to raise under. Proprietary limited companies can now have a potentially unlimited number of investors. So historically, proprietary limited companies are limited to 50 non-employee shareholders, after which they would need to convert to a public structure. And a public structure brings with it a range of additional governance obligations, like being subject to the takeovers provisions, having to produce audited accounts and the like. So it is preferable for smaller businesses to remain with proprietary limited structure for as long as possible. And we in fact now have some proprietary limited companies that have raised through the crowdfunding regime with literally thousands of investors. So it is a game changer because we've essentially now got a new class of company, if you like, the CSF proprietary limited company. And finally, these offers can be advertised publicly. And the impact of this change can't really be overstated because crowdsourced funding offers really have we have far more latitude to advertise these offers on social media and through other channels, whereas even offers that are listed on ASX and offered under a prospectus have very restrictive advertising guidelines. So, and I'll explain a little bit later how Birchal really takes full advantage of the relaxed advertising environment we have for these offers. Other features of the crowdfunding regime is that it's open to Australian proprietary limited and unlisted public companies with net assets and annual revenues of less than 25 million. Eligible companies can raise up to $5 million per year through the regime. Retail investors can invest up to $10,000 per company per year, but wholesale investors can invest above that limit. And I'll explain that in a little bit more detail later. The offers can only be made on a licensed intermediary platform like Birchal. And only one offer can be made at any time. So an offer can't be made on multiple platforms. And all offers must be made under a crowdsourced funding offer document, which is essentially a cut down version of a prospectus. And that is really the intermediary's obligation to review and publish the offer document and host the application facility. And all of the applications are made online. So this is just some data on the year-on-year growth from 2018 to 2019. We're finalising our end of financial year data, so this hasn't been updated. I apologise since January, but I thought it was interesting to include it because this is really where we were expecting the market was going at the start of the year and pre-COVID. So it'll be interesting to kind of look back at these figures once conditions have normalised a bit again. But if we look at the equity crowdfunding market as a percentage of all VC activity in the UK, it's about 6%. So and that's a mature market. So what we've got in Australia is a growing market. And, looking back, a similarly established Australian crowdsourced funding industry could have notionally accounted for about $130 million in 2018 on this comparable data set. So our assumption is that as the increase in so the venture capital industry increases and equity deals increase, as we expected that they would over the next few years, that the Australian market could potentially be around $350 to $400 million by 2023. So just a little bit about Birchal. Alan Crabb is my co-founder and business partner. Alan co-founded Pozible, which is a reward crowdfunding platform. And Adam Vise, he's our chair. And Adam has over 20 years experience in equity capital markets. He was head of ECM at ANZ Securities for many years. And he's currently treasurer at Australian Unity, which is a large health fund. In terms of our performance, since we've launched, we've hosted 44 successful offers and we've raised over $24 million. And really we have a focus on businesses that have a strong consumer proposition because we believe that they're supremely positioned to do well, given the features of the equity crowdfunding regime. So this is a little bit about our process. We really spent all of our time and effort on making it a beautiful and easy to use website, and the company profile pages, which is really where companies spend the most time in presenting their opportunities can be set up in minutes. So it's a very easy and user-friendly process to create the company profile, which is the first step. We've really spent a lot of time on data and insight. So as I'll explain, our process is about engaging with investors and then using data that we get through engaging with investors to give companies some guidance on how much demand exists for their offer and ultimately what they're likely to raise, which is really valuable information in terms of structuring an offer. So there's some information about our process. It's essentially a 10-week process that we work with end to end. And it involves 3 stages really. There's the preparation, which is, as I mentioned, creating the company profile and getting the expression of interest campaign and the offer, the strategy associated with executing each of these set, because preparation really is key. We charge $900 to publish an expression of interest campaign. So this is the next stage. And that will run for about 3 to 4 weeks. Now, during this phase, we've really only got high-level information about the company that we're advertising. And I describe it as a slow reveal, if you like, because we're not wanting investors to self-exclude themselves. We just want to release enough information about the company for an investor to be interested. While the expression of interest campaigns running, companies are typically working on their offer document and assessing the data that's coming in about how much demand is out there for the offer. Importantly, while the expression of interest running, we're asking individual investors how much they would be interested in investing, which is pretty key for us to, I suppose, triangulate based on our previous offers, what we can expect to raise in a campaign. And then we move to the offer phase. And again, it's 3 to 4 weeks. And it's to publish an offer, it's $1,900. And that really covers our background checks and the due diligence that we need to do on the offer document. And then if the offer is successful, and only if it's successful, we charge 6% of funds raised. The other points that I'd mention about our approach to this is that our primary focus is the company's audience. Now that could be a company's existing customers, their existing investors if they've already got them, or the audience that we're able to build for a company. So we treat each campaign as a discrete project. And this is a little bit different to the way that this has been done previously. Historically, corporate advisors and others operating in this early stage investment space would cultivate a list of investors and then really charge small businesses for access to that list. In an environment where we can advertise these offers to anyone, we feel that the most impact can be made if we understand who is the most relevant audience for this opportunity and how can we show this opportunity to them in the most efficient and cost-effective way. So in that regard, we actually spend a lot of time making sure that we've got highly developed digital marketing strategies and customer insights, and we're constantly refining these. But it is really market leading in terms of digital advertising work. And as I mentioned, our audience is less important, but it is still an asset. So the way that we will go to our audience is with newsletters and direct email and so on. But it's not our audience that we, I suppose, rely on to make deals successful. It's how well we market each opportunity, given the nuances of that opportunity that really determines success. And in terms of our I suppose, success or completion rate, there is no obligation to proceed from one step to the next. So, as an example, someone might do an expression of interest campaign and the level of interest may be underwhelming. it's unfortunate, but there's no obligation to proceed further and release the offer document and move ahead. But I would say in most cases, there is enough interest for offers to proceed, and we've got an 83% rate for progression from EOIs through to funded offers. So in terms of offers that we've hosted, as I mentioned, it's businesses that have a strong consumer proposition that we've focused on and tend to do well with equity crowdfunding. But we describe it as having a strong consumer proposition quite deliberately, though, because it's broader than B2C or a company that has a product or service for an end consumer. Obviously craft breweries is what the mind goes to, or certainly for me anyway, when you're thinking about equity crowdfunding. And that makes sense because, people, buy beer, like beer, drink beer, and we've done a few of those. But we've done offers for, Advisor Ratings, which is essentially a data business that provides services to the financial planning industry. 65% of the people who invested their offer were financial planners. So, not as sexy as a craft beer company, but still a very passionate and engaged audience that wanted to support the offer and were excited to be involved as investors. Another one, Capricorn Power. It's a highly technical energy company that they've built an engine that turns waste heat into electricity. So it makes industrial applications more efficient. But they were still able to raise 400,000, and a lot of people in Geelong, because they're based in Geelong, and there was a lot of people that had a lot of love and affection for this business because they're essentially bringing manufacturing back to part of the country that has a long history with manufacturing, but unfortunately, recent closure of the Ford plant and so on is not ideal. So it's not just craft breweries; it's really about the audience, either the audience that the company already has, or our ability to create an audience for the business. Now, mindful of my audience, so I've just kind of sketched out a few of the issues that come up fairly regularly, or we spend a bit of time speaking with companies about, and speaking with the advisors to companies that we're hosting offers for. So thinking about small businesses that might consider equity crowdfunding, there are some restrictions and considerations that you need to bear in mind before this. You can't be an investment company. So that is, you can't raise the money to invest in other entities or schemes. And this comes up particularly in the context of property projects, which are typically structured as managed investment schemes or other trusts for tax purposes. And that's not to say that we can't do property projects, but it's one example of the usual structures not really kind of fitting with what we have to work with under the crowdfunding regime. And essentially the policy behind this is, if you're raising money from the public, people need to know what the business does, not that they're investing money, that investment decisions are then going to be made by the company as to what they do with that money. There are other regimes, and other parts of the financial services industry that can accommodate these kinds of things. That's not what equity crowdfunding is. The other one that comes up fairly regularly is the restriction that you can't raise funds to provide a credit facility to a related party other than a wholly owned subsidiary. And basically the principle behind this is that, although it's okay for a corporate structure, for a parent company to be able to funnel the funds down to a wholly owned subsidiary, that's okay because the investors can trace, their ownership all the way to the sub. you can't say have a director's loan off to the side that then is repaid with funds that you're raising through the crowdfunding regime. And this is something that I think needs to be borne in mind, particularly for businesses that have, loaned money to, or where founders or directors have loaned money to the company, and potentially looking at crowdfunding as a way to repay those loans. Unfortunately, it's not. This is not what it's designed for. Essentially, this is about newly issued, fully paid ordinary shares. That's the only security that we can offer under the crowdfunding regime at the moment. So it's not an exit or liquidity event for incumbent shareholders. It's really to fund growth initiatives. And the shares need to be issued directly to shareholders. So we get asked often about nominee or trust structures. Because people, I suppose, are concerned about having an unwieldy register of shareholders, but that's not permitted in Australia. The shares need to be issued directly to the shareholders. Structuring considerations. So shareholders agreements are actually pretty problematic for us for a variety of reasons, but perhaps the main one is that shareholders agreements, being deeds in Australia, is a quirk of law. They require a physical signature to be put to paper for a deed of accession for any incoming shareholders. Although everything that I've just said, there's been some recent amendments during COVID to expand the electronic signing requirements for certain documents. So this isn't kind of 100% true at the moment, but typically it's an accepted principle that you have to physically sign a deed of accession. Now, this is problematic if you end up with, hundreds or potentially thousands of shareholders through an online process, and then need to go and procure signatures from every single one of those people to onboard them as shareholders. The other point is that there are a lot of things typically in a shareholders agreement that someone investing a few $100s would find it difficult to sign up to. And what I'm talking about here are non-compete clauses. So a shareholders agreement is pretty common to restrain directors from or shareholders from working for a competing business. Now that's fine if you own a not insignificant share of the company, but if you're only investing a few $100s, I think you'd be surprised to find that you've are subject to these non-compete restraints. The other point I'd make is constitutions typically need to be revisited when you're doing a crowdfunding offer. So companies really need to consider what life is going to be like having potentially hundreds or thousands of shareholders. And a lot of the fear and trepidation of this or this uncertainty, I think, can be managed by getting some good advice and having the proper governance arrangements in place, so you won't be hindered in terms of running your business moving forward, deciding or thinking pretty clearly about what things can the board do without needing to get shareholder approval, and just having those things clearly set out in the constitution. And typically, life can go on without too much trouble. Sometimes we've got issues with state legislation that we need to traverse. So the biggest one that we deal with at the moment is that South Australian and West Australian liquor licensing is inconsistent with the crowdfunding regime. So, and what I mean by that is they have proper person tests that apply to all shareholders in a proprietary limited company. And these laws were drafted in, I suppose, an environment when, a proprietary limited company not having more than 50 shareholders was a, irrefutable truth. But it's not true anymore. And what that means is in South Australia and Western Australia, if a proprietary limited company were to, that had a liquor license, was to do a crowdfunding offer, every single one of these incoming investors would need to be subject to a fit and proper person test, which involves police and probity checks and things like that. So that's one example of state legislation being inconsistent with Commonwealth laws that we just kind of need to be mindful of when we're looking at these opportunities. And then the other one's principal place of business and director residence requirements. So sometimes we get companies that either are international or they have international operations. The requirement is that a principal place of business has to be in Australia. It's Australian companies, and also directors. So you need a minimum of 2 directors to make a crowdfunding offer as a proprietary limited company, and the majority, at least one of them, needs to be an Australian resident. So we've had a couple of international or businesses with international operations that have had to kind of traverse and overcome these issues as well. In terms of the investment restrictions, I've spoken about these a little bit before, but I just wanted to call out, wholesale clients, or who is a wholesale investor, because there's a little bit of a difference between Chapter 6, which is, the way that wholesale and sophisticated investors define, for most other offers, and what we have to deal with in crowdfunding. And it's typically, it is a wholesale client under the Chapter 7 definition of the Corps Act. And it is a little bit different. There are some, subtle differences between the definitions, but, and despite that they're subtle, they are important. Birchal chooses to do this. So that is determine that someone is a wholesale investor, so we can not treat them as retail, and that is so they can invest more than $10,000 with an accountant certificate. So that means that an accountant is certifying that they've got greater than $2.5 million of investable assets, or greater than $250,000 in gross income for the last 2 financial years. And the certificate has to be issued within the last 6 months. And then financial statements, this is probably the area that will be most relevant to your audience, but there is some, I suppose the way that the regime has been prepared, it is open to some interpretation, but having published these offers and engaged with ASIC on this, I think we've got some clarity that the key financial statements that need to be included are a balance sheet, a P&L, the cash flow statement, and a statement of changes in equity. And I understand that not all businesses prepare this, but that's, I suppose, not a reason to not include them in the offer document. ASIC's expectation is that those 4 key financial statements are included. And typically it's the financial statements for your most recently completed financial year, or if you haven't completed your first financial year, financial statements up to 1 month before the date of the offer. Now, most companies include additional information based on management accounts to update to a reasonable amount of time. So we've just gone through our 30 June year-end process, and a lot of companies were very keen to get their offers open before 30 June because they were including their 18-19 financial statements, but then they were updating with management accounts to 31 March 2020 because 30 June 19 was almost 12 months old, if you like. So they're a few of the things that accountants typically help clients that are looking to do a crowdfunding offer with. I'm just mindful of time. I've got a couple of case studies here which people can have a look at in the slides when they in their own time. But one of them is Shiva Rideshare. We raised $3 million for them in March 2019, and they came back and did a subsequent round towards the end of last year. It remains the largest offer hosted under the crowdfunding regime to date. So I'm delighted to help them a couple of times now. And then Chief Products was an offer that we launched in December 2018, and it was a pretty ambitious timeline. And it looked as though that they weren't able to complete the offer because it was, a difficult time of year. But they came back and reset, and we were able to complete an offer for them just a few months later in March 2019. So I thought it was a good example to show that, not getting an offer complete is not the end of the world or the end of the story, that it is possible to pause, regroup, and come back and engage with the market when there's a more appropriate time to get the deal away. And then I thought I'd just finish on our performance through the COVID-19 pandemic. I mean, it's fair to say, like most parts of the industry, have been pretty nervous and pretty concerned about what COVID means for us. I suppose we decided that we have an opportunity to help businesses that need to raise capital during these difficult times. And delighted to say that, you know, since the 1st of March, we've funded 8 successful deals. So around $4.6 million and 4,000 investors during this time, which, you know, we're certainly extremely proud of because, you know, it's been a very challenging and uncertain time to be raising capital. And we've got a few offers that are currently live, and I've listed them here as well. But things are starting to look up and improve, despite the setback here in Victoria. But you know, it is really encouraging to see that investors are still interested in investing in businesses, and particularly businesses that you know, they're able to, you know, I suppose look ahead, and I suppose the view is do well in a post-COVID environment. So, and then lastly, this is just some media coverage that we've had, but I think what I'd like to leave everyone with is that you know, the equity crowdfunding regime showed a lot of growth and promise last year. I think it still has a long way to go. We've performed extremely well and during the escalation of the COVID pandemic, and I think once conditions start to normalise, you know, more and more companies will actually look at this as a viable way of raising capital. So thanks very much for your time.
Matt, thank you very much. That was a very interesting overview of the virtual journey, and also the state of crowdsourced funding equity raising in Australia. So congratulations. This has been a very interesting process we're involved in. We have had 3 other speakers, I think, from the crowdsourced funding industry, and we've had a different story, a different journey in each case. And we're going to put all these together, all these recordings, and have them on our website, and also circulate them back to the intermediaries, of course, because I think it's fantastic. So good luck, because I really believe Australia needs a strong crowdsourced funding industry, most definitely in 2020-21. And I hope we can get accountants involved in making sure these are investment ready. And you've shared some very interesting information there today, and I've learned a couple of things. But one, and you do have a beautiful site. I will agree with that. Your website is very well presented. And in fact, I personally am very happy with the standard of the presentation that you and a couple of your other co-intermediaries have achieved. Because when I first read the legislation, I thought, geez, this is going to be pretty dry. But you know, I think you've adapted well, and obviously ASIC's gone along with that at some stage, so that's great. There might have been a few disputes along the way. But I do want to ask you one question though, because you haven't mentioned it at all. Do Birchal like the opportunity of companies trying to raise some capital under Section 708 of the Corporations Act before undertaking a crowdsourced funding equity raise?
Well, I suppose the question is how long before. You know, you really want to put all of your effort into an equity crowdfunding offer, and you know, success breeds success. And the way that our process works, it's like any crowdfunding campaign, is that the early money is the hardest money to get, and then you leverage the success of the early money and the early traction to get more. So I think you're kind of doing yourself a disservice by raising elsewhere, because then you can't use that traction, or it's more difficult to use that traction to encourage other people to invest in the offer.
Okay.
Yep.
Right. I just asked that because some industry commentators have indicated that they have a preference for that, and as you did mention, I just wanted to clarify it, and I can understand what you're saying. Amanda, do you have any questions or comments on what Matt's had to say?
No, Matt, that was very interesting, and I have followed the Sheba story. Peter told me about that very early on in the piece when I started working with Peter, and it is a very interesting story, and I've relayed it to many as well. So well done for that. But no, I think it's a great looking platform, and what you're doing is, amazing. So it's lots more things to come, I think.
Thank you. Thanks very much.
So thank you very much. Now, we might just go back, and there are a couple of things that I just wanted to bring up, and we'll do these quickly. Our COVID-19 update, most accountants probably know the coronavirus SME guarantee loans cease at the 30th of September. So if you've got clients that you think need to get one of these loans, please do so. The major banks announced a couple of days ago that they will be prepared to negotiate to extend the 6-month holiday for a further 4 months for any of your clients who have borrowed money, but this is not going to happen automatically. Businesses will have to apply. So I think you're going to need business plans, budgets, cash flow forecasts to take to the bank. Most of the states and territories are now organised for the home builder renovation grants, the $25,000 grants. There is a means test based on income in the 2018-19 fiscal year. The main beneficiary from the SME point of view will be the building industry, the land development industry, construction, and some trade businesses, primarily built around kitchens and bathrooms, as I read the rules. So the Prime Minister has said that they may extend the deadline to the 31st of December because of the late start by some of the states. And that was all over getting access to information from the tax office. And that's not easy to get, because that was really confirmation of what people's earnings were in the year ended 2019. Don't forget to monitor your clients to see if their turnovers dropped in June by more than 30%. They may be eligible for JobKeeper, and you could apply. And the second phase of the superannuation drawdowns of $10,000 maximum are now available through to the 30th of September. Amanda mentioned the CommBank Accounting Market Pulse report. It was released 2 weeks ago. If you haven't read it, please read it. It's vital for your future as accountants. One of the questions they ask on page 11 is, which practice areas do you expect to be most in demand in 2020-21? Well, they said the next 6 to 12 months. Which services do you anticipate? And the answer was business advisory services, and it got a 70% rating. And the following one was business recovery and insolvency, 61%. I think you need to think about this if you're currently a firm that's primarily involved in preparation of annual accounts and income tax returns. There's an expectation now that's been brought on, I think, by COVID-19. And there's an understanding also by many SMEs that you, as their accountant, can do a lot more work for SMEs than what you have traditionally done for them as a tax return preparer and an annual account preparer. And this is all about helping them in their future operations. And one of the key questions that you should be putting to your clients, I suggest, is how they're going to fund their businesses. Virtually, and this gets back to the action plan we've got here, virtually every commentator in the financial press for the last 2 months has been warning that after the 30th of September, when the main part of JobKeeper is going to be dismantled, sure, the government might continue it for some industries like tourism or some areas. Victoria might get some sort of extension. But in the main, it's going to dry up. How are your clients going to survive then? We're also going to have the problems with the temporary changes that have been made to the Corporations Act relative to directors' responsibilities on ongoing trading, and the action that banks currently cannot take to recover debts. So now is the time to be looking very closely at business advisory services. Have a business review meeting to determine a strategic plan. Look at how the business is going and try to identify if there's going to be shortfalls, because one of the consequences of post 30 September is going to be banks not being very interested in lending money to SMEs. If they're a well-run business, they've got a vision, they've got a good leadership team, they've got a will to run a great business, then I'm sure Matt and his team would be happy to talk to you and your clients about whether they are suitable to raise capital as a crowdsourced funding equity raising company. This is all going to come to the fore, though, by you being very proactive in developing a strategic plan for those clients. So ESS BizTools can assist if you need any information on any of the packages that we offer, which include crowdsourced funding and early stage innovation companies. Please contact us, and other things like debtors and research and development and government grants, corporate governance, etc. You can go onto our website, essbiztools.com.au. So thank you very much for joining us today, or whenever you're watching this video. Stay safe. Have a great day. Thank you very much, Amanda, and for being with us today.
Thanks, Peter.
And Matt, thank you very much for joining us from your location outside of Melbourne and giving us a very interesting overview.
Thanks very much.
Our next webinar in this series is next Friday, and I'm just moving through here a bit. The presenters are Trent Butler from Trent Butler Consulting in Sydney, 7 Steps to Marketing Success for a Professional Services Business in a COVID-19 Environment. And we have Matthew Karakalakis from AMK Law in Adelaide and Melbourne, who's going to be talking on effective dispute resolution mechanisms in Australia. So thank you very much for being with us today. Once again, thank you, Amanda and Matt. Have a good day. Goodbye.
Thanks, Peter. Thanks,
Thank you
everyone.
very much.
Bye.
Thank you.
Bye.